What is going on, everybody? It is August 13th. Welcome to Gary Cardone's show on Gary Cardone's YouTube, where Gary Cardone is currently not present because he's enjoying his life in the Bahamas fishing. He's got some updates for us, by the way. I don't know if you're not following Gary on Twitter, you need to be, because he was just telling us the other day on some of the size of the fish that he was catching, which, of course, I envy greatly and is awesome. But we still have a show to do, so I'm thankful for Chris showing up here to talk about the markets, some trading. I probably got a few questions for you, and I want to go over this article that I read from Zero Hedge. But first of all, Chris Inks, thank you for being on the show as always.
Man, always a good time, man. Love you guys.
Did you watch the Elon conversation yesterday with Trump?
I didn't get into it live, I kind of had the same thing everybody else had, but I came back later and listened to it. So yeah, kind of heard what was going on, what they said. Trump's kind of stepping up there saying, listen, these are the things that that really need to be done. And, in his normal Trump fashion,
Yeah, of course.
If you can get past that, a lot of people have because he's gruff, right? He's a little rough.
Yeah.
And most people, especially today, where we're all taught that we have to be politically correct and we have to be nice and all these things, he comes from a different world, a different, first of all, time period, and the way the world was at that time, it wasn't a lot of what we're dealing with. So, once you get past that, and you start listening to him, it's hard to argue that he's wrong. I mean, it really is. We got to, protect our borders. Otherwise, anybody can come in and do anything they want. They talked about fossil fuels. They talked about the dollar, about spending, all the things that people really should be interested in. If they're serious, really about what the condition is now, right?
What did you think of the format? Because I thought it was actually pretty cool that it was just like a conversation between two people, although, of course, Trump probably talked 90% of the time. But I thought the format was pretty neat.
Yeah, definitely. I think I would like it better for candidates to be going through this, because when you get into the debates and whatever, it's easy to get. It's like being online. We all know we shouldn't, feed the trolls. We know we shouldn't respond to them. What we do, and then we look at it afterward, and it's the same thing in the debate. Debate, you can get on the question, and then somebody else kind of butts in a little bit, and then you're like back and forth, and I like this better when we get out there and can talk about what it is they want to talk about, and we can see what do they believe is important with what's going on with them. So, look good with Trump. I'd be interested to see it with Kamala and see how that goes as well. But yeah, I like the format.
Yeah, if she does it. But I agree with you. I like how there's a lot of time to just let them talk. Not a lot of quote unquote interruption. It seems like a friendly environment. And sometimes that's all you need is to actually hear a candidate talk. And if it's something, they'll trip themselves up, right? Because when you give them room to breathe, they fill it up, right? So that's sometimes I think the best way is just, hey, let them rant. Let them talk, and you'll really find out some of their policy positions.
No, I agree 100%, man. Yeah, what is that saying go? Give a person a rope, long enough rope, and they'll hang themselves. So yeah, let them talk.
100%. Well, I want to go over with you today as a start, and we can talk about Bitcoin, the markets, trading in general. But I found this specific article from Zero Hedge to actually be very interesting, and I wanted to just read it through with you and through the audience and get some of your feedback if that's cool.
Yeah, definitely.
So, and I go through Zero Hedge, probably a couple times a week. I think they're one of the more fun publications that I like to read, really accurate economic data. And so this one, a message for the crash caller. So I immediately was like, oh, this is something that I'm going to want to read. The crash callers are out in full force once again. Of course, I thought of you too, because we're always talking about the people who are doom and gloom, right?
Yeah.
The problem with calling for a crash is that you're wrong 99% of the time. Then once every few years, you're correct. The whole process reminds me of a broken clock, which is correct 2 times a day, but wrong the other 23 hours and 48 minutes. Remember, the purpose of investing is to make money. The easiest way to do that is to ride bull markets for as long as possible and then get out before a bear market crash hits. But what about the investors who make huge fortunes during crashes like the great financial crisis of 2008. Let me bring you in on a dirty little secret. Almost no one made money during the market crash in 2008, and the people who did were in situations that you or I will never be in. And I didn't even know what he's about to say. I hadn't heard of this before. In 2008, there were roughly 216 million American adults over the age of 18. Roughly 60% of them had exposure to the stock market via brokerage accounts or retirement accounts. So we're talking about roughly 130 million people who were involved in the stock market in one way or another. The number of investors who got rich betting on the crash at that time is under 30, which is insane. I had no idea it was that low. So we're talking about 30 people out of 130 million succeeding. That's roughly 1/10 millionth of 1%. To put that into perspective, you are 10 times more likely to be struck by lightning. The odds of happening are 1 in 1 million. Moreover, those few investors who did get rich from the great financial crisis were all in highly unusual circumstances, none of which apply to the typical trader individual investor. John Paulson is a famous hedge fund manager who became a billionaire betting on the housing crash. What you might not know is that the only reason he succeeded, which was because he personally had Goldman Sachs build securities that were chock full of garbage mortgages, which Goldman Sachs then sold to other clients so Paulson could bet against them. That sounds totally fair and ethical. This was unethical and borderline illegal, and individual investors like you or I would never have this opportunity. When was the last time you told Goldman Sachs to create something for you to bet against? Michael Burry is another hedge fund manager who got rich from betting on the housing crash. He had to lose money for 2 years before his bets worked out. And even once things went in his favor, the investment banks who sold him the securities he used to bet against the housing market refused to value his trades as profitable. To top it off, his investors tried to withdraw their funds. When Burry refused to give the money back, they sued him. What followed was years of legal hell as well as an investigation by the FBI. So let us consider this. The odds of making a fortune being on a crisis or some other black swan event are less than those of being struck by lightning. The small handful of people who do get rich from these situations do so either because they A, have a ridiculously unethical setup like John Paulson, or B, are willing to experience a nightmarish scenario for months or even years like Michael Burry. Which brings me back to my original point. The purpose of investing is to make money. The easiest way to do that is to ride bull markets for as long as possible and then get out before bear market crash hits. Put another way, the crash callers have investing totally backwards. You need to focus on the 99% of times stocks don't crash, not the 1% of the times they do. So obviously, investors need a tool for determining whether stocks are simply correcting in the context of a bull market or if a legitimate crash bear market is about to unfold. And then he just gives his pitch. Hey, I made that tool. But I thought that was a really interesting article for a variety of reasons. But I wanted to get your feedback. Give me just your initial opinion on what was said in there, and if there's anything that you took away that you think is important and we should emphasize.
Yeah, no, that's exactly the thing. Especially in social media here, if you're trying to trade, you've got a lot of these supposed short specialists or whatever. Oh yeah, making all this money shorting. But the reality of it is, very few actually do. Because as human beings, we're kind of looking for the best possible scenario, right? We're looking for what normally happens. Everything left to its own devices, everything equal. Asset prices are generally going to go to the right and up, which again is why when we're looking at volume is telling us how is supply coming in. That's what it's telling us, and then how is demand responding. Because if you don't have the supply coming in like that, the demand just kind of continues to carry price higher. So when you think about that, the odds are greater to be long than they are to be short. The other thing being that if you're short, you can only go so short, right? You can only go to zero. To go long, though, you can go long potentially, theoretically, infinitely, right? It can continue to go up, right? What's going on with the stock market over the last 100 years? It's done nothing but go up. There's been periods of time where it's gone sideways and pulled back along the way. But in the grand scheme of things, it has continued to go up. So there are these limitations to shorting. Now, that doesn't mean you can't make money when the market comes down, but it's a lot more difficult for pretty much everybody than what they want to believe it is. So if you focus more on the upside, you focus more on being long when the market's going up rather than trying to be short when the market's going down, you're going to fare a lot better. The other part of that being that because when the market comes down, crash or whatever, there are corrections. And corrections, even on a short time frame, are very hard for traders to trade. Most don't understand that they come, that they play out in a certain way, that they have a certain structure to them. And so a lot of people, what they'll end up doing is they'll make good money going up. It's easy to make money if you go long, if you have a long enough period of time. The place where they end up having a lot of trouble with themselves is when we do get those corrections. Because then they end up usually losing just about everything they've made on the way up, and often more than that. They're putting more money in because there's so much choppy price action. So, yeah, I agree a lot with what that article says there. As a regular investor, the odds of you getting wealthy off a crash are not going to be there, even if you get the timing right. See, and that's the other thing. Everybody throws around that old comment, that old quote, that the market can stay irrational longer than you can stay liquid.
Yeah.
And all that means is when we talk about irrational, we're talking about our view of it, right? So if I think the indicators are saying we need to be in a recession 2 years ago, and I've been saying that for 2 years, well, to me, it seems like the market's being irrational, right? And if I'm going to keep trying to short that, I'm either getting stopped out consistently, or I'm Michael Burry, who's taking a huge hit because the market just keeps going up rather than down with the shorts. So when you look at that, it's first of all, you have to understand again what I just said there, which is when we say that, we're talking about irrational because we think the market needs to pull back because of whatever we're looking at, but it doesn't. So that to us is irrational. And so calling tops is often really difficult. Sometimes we'll get them, sometimes we'll get close, but to be able to do it consistently every single time is not going to happen.
Is there anything in the article that you thought was wrong, or that you thought maybe he overstated?
Not really. I mean, he says 30 people got, rich. And so I think when we're looking at that, he's obviously not talking about people that made money. He's talking about people that made stupid amounts of money, right?
Yeah.
So I can see that, other people get in with whether they got it at the top or not, got in somewhere along the way and probably made money, likely made money on shorting it down for a bit. But, when people read that, probably like, man, just 30 people, nah. But I think, what he's referring to are like exceptional amounts of wealth that they created in that. So that would be my only thing. I think that I would look at that and go, yeah, somebody might read that and go, no, but I think you have to look at it more along what he probably meant with that. Because, myself and others, we did make money on the downturn. I didn't get it right where it was going down at the time. I felt like it was going to go down. Like that. I believed it was going to go down. I was a few months off. So at least not a few years off, but still, not enough to definitely get in and go, oh, I got to try and catch this top.
What did you do? What can you actually go more into detail on that? What did you do in 2008? Did you try to buy some of these? Now I don't want to call them options. Did you buy some of these options, or were you just trying to get in real estate in general? Or
yeah, no. So when I was looking at it, coming up into it, right? But again, with me, it's all about social mood, right? What's going on there? How are things going and whatnot? And so, running up into 2007, into 2008, it just seemed like from a social mood perspective, and then looking at, a few other little indicators, it really looked like things were topping out. And so, I wasn't doing options at the time, which would have been great if I was. I could have, bought some puts on that. But I didn't. But I was able to short some good companies coming down. And then even more so, the better thing of it was actually buying them, at those lows when you were about, the first quarter or so of 2009. A lot of people don't realize it, but, we get scared when we think about the market pulling back against us, but we need to look at that as opportunity. Because once we look at an opportunity, then we realize that once the correction is over, there's a ridiculous amount of money to be made buying these things stupid cheap, right? We can even look back at, just over here, 2002. when we had the swing low down there with with crypto and stocks and everything toward the end of 2002. I'm sorry, 2022. And there were things that you could buy at just stupid low prices. And you go look, you just pull up TradingView and go back to 2000 to Q4 of 2022 and just start looking at stocks and look at how much they've rallied over the last 2 years, or crypto since then. So it's not even that you have to catch the down move there. You could just get into cash and then buy at or near the lows. But that takes a different mindset than what most people are doing, when they get in. Everybody wants to have the big returns, but they want it to happen overnight. And that usually isn't the way it happens.
I think what I liked about the article is also brings to the reality the third, because it's always human nature in social media. We don't see the people who made moderate amounts of money. We don't see the people who did really well. We see the ones who did the best, right? Yeah. And to his point, okay, some of the people who did the best literally were doing so with opportunities we will never be able to have. Maybe they were unethical, but then even Michael Burry, like, I didn't know that he had lawsuits that far after, and FBI investigations that far after his wealth. So then it's like, you only hear about the success and you go, wow, that guy made a great bet. He's rich, must be nice. And totally disregard 2 years of investors trying to sue you to get their money back. 2 years afterward, not even getting the credit given to you, I guess, by the financial agencies. And then the FBI going, how did you know all this was going to happen, huh? So it's very fascinating to me, because it is that retail mindset, isn't it? Where we just look at the shiny object and kind of forget everything that got it there, everything that surrounded that mega wealth. And then we totally forget about how to just slowly get wealth, right? Yeah. As opposed to like, man, I just need to find the next market crash. I just need to find the next market crash.
Exactly. But we always talk about it because we talk about trading. So we often, most of the time, just talk about it in terms of the retail mindset of trading, retail traders, right? But as I've been pretty consistent on when I speak, these are things that just as human beings we often see throughout other areas of our life. And so, you have to excuse me here.
Woo, bless you.
Sorry about that.
No, that's great. That was a good sneeze.
But yeah, and so when we look at it, we can look at other areas of our life where it's the same way, right? We're dating somebody and they're not feeling it soon enough, or we're trying to get through some kind of education that we're getting through. It's not coming quick enough. We're trying to get a promotion we want. It's not coming quick enough. And it shows up now in social media, right? We look at where social media began with Facebook, and then where it is today with TikTok, right? So Facebook just static post or whatever, and then it gets to video, and it was longer form video, YouTube and whatever. And now it's shorts, Instagram shorts and YouTube shorts, Instagram reels, I guess, whatever, which are pretty short. And then you have TikTok, which is like even shorter, right? So the attention span continues to drop down lower. People have this need for this dopamine fix. And so it's just, we've lost this whole idea of actually being patient in life. And that really kind of, I think the real bad thing about that is it has you focusing right on the here and now in everything you're doing in life. And you're missing the forest for the trees, right? You're seeing everything that's happening as it's happening, but you're missing what's happening. And next thing you know, it's a year later, it's 10 years later. And what have you done during that time? And so we tend to get caught up in all areas of life, but again, it really shows itself there in trading as well.
So what are we seeing in the markets right now? And you're more than welcome to share your screen if you want to show any charts or any graphs.
Yeah.
But I'd be really curious to see what's going on. Oh, I got to make sure it's here. Yeah, there you go.
Yeah. So we'll talk about this in just 1 minute. So somebody that I follow that, again, I've mentioned before, and I don't get anything from it. He doesn't even know who I am. But it's a guy named Michael Howell. And as this last year or so, everybody has gotten more into the idea that liquidity is ultimately what drives markets, right?
That's what that guy on our Twitter Spaces kept saying, right?
Yeah.
Yesterday, and you're giving him the 100s. He was saying it's all about liquidity.
Yeah. I mean, now that doesn't do anything with the little movements, but overall asset prices rising are the result of global liquidity expanding, not just in the U.S. It's global liquidity. And so Michael Howell is basically the guy when it comes to global liquidity. And he has on Substack, he has a newsletter called Capital Wars. It's $75 a month.
Oh, okay. Okay.
Yeah, he goes into it, everything. And so from the beginning of the one back on August 6th, it was the Global Liquidity Watch weekly update. He says volatility markets highlight concerns that the U.S. Fed is behind the curve in timing its policy easing. Although a rate cut appeared slated for September, given the benign inflation prints, Fed liquidity has stalled lately, and U.S. economic data looks weak. Yet the setback in markets looks to us more of a downward adjustment in excessive risk positioning and possibly a shift away from the U.S. dollar rather than a reversal in the liquidity cycle. In fact, the latest weekly data shows that global liquidity growth is accelerating and liquidity levels have recorded a new all-time high. Now what does that mean?
Can you state that like I'm an idiot?
Yeah. So basically what he's saying is a lot of people, because the last week, Monday, the 5th of August, was when we had the yen carry trade thing happen. The markets took a hit, right? And so his thing here, this was the next day, he came in and he said, listen, when we see all this, what's going on there, people are saying that, oh my gosh, that there's no liquidity now. Liquidity's dried up. And that's why all this is going to happen, because as liquidity dries up, there's no extra cash out there to go into the markets. And he's saying, no, actually what that looks like is the all that excessive risk positioning, which was the yen carry trade, all that kind of stuff going on, and possibly a shift away from the US dollar was what caused what happened, rather than the reversal in liquidity cycle. And then he goes on to say that the global liquidity growth is accelerating and liquidity levels have recorded a new all-time high. So when people hear that, they go, well, why aren't the markets rallying then? Why do we have this pullback, right? Or specifically, a lot of the audience here, why is Bitcoin not rallying yet? Because it takes a while for it to happen, right? So when we talk about global liquidity, it's not money that flows from the central bank to the people. It's the money that flows from the central bank to the primary dealers, to the banks and whatnot, to the governments or whatnot, which gets eventually kind of finds its way into the markets, right? Because like here in the US, the Fed, it's against the law for the Fed to actually send money directly to us, as the citizens. There has to be that intermediary. So global liquidity, when it does this little reversal thing, it kind of like bottoms a bit and then it starts moving back up. And then it takes a while for the markets to actually follow with it. So if we look at what's going on with global liquidity and this idea that it is accelerating and it's increasing, then what that should say is ultimately price should go higher. That does not mean price can't dip down a little bit lower first and then rock it up. But what it means is, going back to what we started with at the beginning here, being long in a bull cycle is a lot more productive financially for you, profitably for you, than it is trying to short every time you get to some level and you say, oh, the top's in, the top's in, the top's in. And so when we look at this my big chart that I've had here since the 2002 bear market low, and we're just kind of, again, we've rallied up to that pivot on the daily. So really what I'm looking for is impulsive breakout above that pivot there. And if we can get that, that's going to signal that the bottom is likely in, but we still need one of two reclaims, depending on the way you want to look at this, right? So in terms of Elliott Wave, we would have to break above Wave X, which is 70,771 on this Bitstamp chart. And doing that's going to add confidence to the count and say the Wave 5 is in target, in progress higher. As far as market structure goes here, we are still in bearish market structure. Some I keep pointing out. We've got a high, a low, a lower high, a lower low, a lower high, and a lower low. So we're still in bearish market structure until we break out above that last lower high here on this chart. It's $70,016 here. Once we break out of that, that breaks that bearish market structure, and it should indicate that we're likely to head higher. So, we've got three different ways we're kind of looking at it here to suggest this low may be in. Each one adds significantly more confidence than the previous one. So, ultimately, it's getting above this swing high here that will suggest, all but guarantee that low is in. But this is the quickest way we do it, is through this this pivot here right around, what is that? Right around 62,750 or so. So, you kind of work in steps as you're looking for confirmations on what's going on with the structure there. And so, that's kind of where we're sitting here. So for me, it seems like the low is in here. But, again, opinions are worth nothing, right? It doesn't matter what I think. It matters what actually happens. So even though I think that's what it is, and I'm trading according to that, I do have my three levels there that I continue to watch on this larger time frame that are going to help me to figure out, am I right on that as it continues to play out there. So,
you go ahead.
Oh, no, go ahead.
Well, I was going to backtrack a little bit and ask you how liquidity grows. Like, are you saying we're short of liquidity right now? Like, just kind of returning to some of what you were saying previously. I just want to make sure I have a good grasp of, one, how you determine how much liquidity is in the economy, maybe the US and the world economy, how that grows, and then if we have sufficient liquidity now or not.
Yeah. So basically QE, that's the easiest way people know.
Printing
Fed
money,
talks about QE.
right?
Yeah, printing money. That's the way that's the way it's going to grow, right? So we had quantitative tightening over the last quite a bit over the last 2 years, more or less. Matter of fact, we had the M2 money supply drop by a larger amount than it had done like in decades and decades and decades.
And interest rates are tied to that, correct? The higher the interest rate, normally the lower the liquidity in the market. Am I correct?
Yeah. So basically, the way the interest rates work are they're supposed to be there to either encourage or to discourage investment. So if your interest rates are lower, what the government, the Fed's trying to get you to do is to spend money to take out credit, right? And by the way, that's another part of liquidity is credit. That's a big part of it, right? So that isn't actually money printed by the Fed. That's money printed by the banks, reserve banking, right? Fractional reserve banking. And so when we're looking at that, if you're looking at interest rates, the reason why the Fed raises the interest rates is to get you to stop spending. It's to get you to stop. It's to get the banks to stop loaning out, creating credit. Is to get you to stop taking out credit, because the idea is the economy's overheated, inflation's running too fast, and in order to stop inflation, we need to curb that spending. And so when you're cutting those rates, right, you're pulling back on that. You can think of it as what the Fed did here over the last couple of years, where they rallied it up like 8 or 9, rate hikes, just boom, 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 right after another. You can think of that basically as driving down the road 150 miles per hour in your sports car and just yanking up on the e-brake, right? And it kind of stops. When they start cutting those rates, right, then that's kind of, putting that e-brake back down and kind of allowing your car to be able to pull more again, to start moving again. And that's what it's trying to do. The liquidity itself, though, as far as so that stops liquidity as far as banks creating, fractional reserve banking creating more dollars out there through credit. But that's not directly the Fed actually printing money. So there's two ways in which liquidity is increased in your system. One is by lowering the interest rate, again, because that encourages banks to make loans. It encourages people to take out loans. And then two, of course, is the Fed actually printing, the dollars or other central banks printing their fiat currency.
So currently right now, is there too much liquidity or not enough liquidity in the market?
All right. So currently right now, what we had was over the last few years with quantitative tightening here in the US and in other places, they were, soaking up their cash, right? Whatever their fiat is. And so we had, it works in cycles. Basically, it's a 4-year cycle. Amazing how that works, right? Kind of like Bitcoin's 4-year cycle. At least it's been for the last few decades. And so what happened is we got to this peak liquidity. And then, again, when we got to like coming up into the pandemic and whatever. And then we got the pullback on liquidity. There's this, let's stop printing. Let's raise interest rates. Makes it difficult for people to take out loans. So you're cutting liquidity on two fronts with that. And that's what we've had. Generally speaking, there's some arguments about the way in which the bonds have been sold to the Treasury and the way in which that's working as potentially some kind of stealth liquidity. But we're not going to go into that. That's really deep. But as far as Fed printing or your central bank printing and or your bank creating loans, that's been pulled back over the last few years. Now we're getting to this point now where, okay, if the Fed starts pulling back on interest rates, we're going to see here in the U.S., we're going to see that open up some liquidity. People are going to be able to start taking loans and doing that. And then, of course, the idea that the Fed is going to print more money to deal with everything that the Congress is saying they want to pay, they want to do. And so that's just the U.S., but we know China's already been injecting liquidity for, a couple of months now into their economy. And then we saw the UK over there, what's going on with the central bank over there, and they were already dropping their interest rate. So again, it's global liquidity, what's going on there. And we're seeing a lot of that starting to happen everywhere as everybody kind of pulls back from all the spending, all the money they created there during the pandemic and just right after that. So we pulled back and now we're going to go up is the idea.
Okay. So it's interesting though. Like we had interest rates near zero for how many years? 8, 10 plus years.
Yeah.
And so that meant we should have been flush with liquidity, but then I'll listen to someone like Jeffrey Schneider and they'll say, actually, like we need more liquidity in the market. There's not enough liquidity in the market, even with all the printing. And so like, why would we now decide to start pumping liquidity in the market? I know we've been raising rates to quote unquote combat inflation, but it seems that the economy hasn't been doing amazing. Maybe it hasn't been doing terrible. So did they know that going in that they would be hurting an already hurt economy by essentially causing, I don't want to call it a liquidity crunch, right? Because a liquidity crunch is what will cause a recession, right? When there's just no more liquidity anywhere. I don't want to be mixing up any of my terms, but can you make some of that make sense for me?
Yeah. So again, like you said, we're basically zero interest rates for quite a while there. And of course that encourages investment. So one of the places we can look, I think that's a great kind of showing that what was going on there was if we look at horizontal drilling and fracking. Okay. So during probably around 2015 or so, private equity money really started flowing in. It's very expensive compared to regular drilling. Horizontal drilling, fracking is very expensive. But it's a way in which we can pull out a lot of excess oil and whatnot that we weren't able to do before. And so, of course, that was something that was, invented here in the U.S., really here in Texas, Eagle Ford Shale down San Antonio area, which is where they really started doing that. And so what happened was all of a sudden we started pumping oil, right? All of a sudden it was like, well, it doesn't matter that, that it cost all this much because we're able to pump so much more money and make so much with it. So the money flowed freely, especially in the last half, from 2015 to 2020, from these private equities into these oil drillers flowed in there. They came out, and what happened? We became the number one producer of oil in the world, right? Yeah. And so we did this. And then, as you got toward the end there, 2019, 2018, 2020, right around there, all of a sudden the money started drying up a bit. The liquidity started drying up a bit. You saw the Fed tried to come out, I think it was 2018 or so, rallied, they were going to try and do 4 interest rate hikes at the time. And I remember specifically with our TWC students, I actually said, no. I said, no, they're not going to do this. As a matter of fact, we're probably going to have 3 or 4 cuts. And that's what they did, right? They cut. But that coming in there, anyway, the money kind of froze up a bit there and stopped all that horizontal drilling, all that fracking, as everything kind of went down as you got in 2020, where there was no more need for it at that point because, again, nobody was traveling come 2020, right? So that's why we saw that great big oil crash there in May of 2020 because nobody was going to take all that oil they normally took, the airlines and the cruise ships. And so if we look at how does money out there equal what's going on, I mean, that's one way we can look at it. We can notice how all that money flew in there because, again, it is a lot more expensive. It's a lot more difficult and more expensive to drill horizontally to frack than it is to just drill like we normally drill for oil. So the fact that we had so much cash just flowing in freely, I mean, they could get it anywhere, was just this sign of the times of what was going on. Now, obviously, as you create more and more debt and in your fiat currency expands even greater, you're going to have to continue to increase it greater, right? So the thought with Austrian economists, and I studied Austrian economics for a while, and I love the idea of it basically, but then it hit me one day, we're in a debt-based economy. And so austerity, where we're culling back on all that all of a sudden, doesn't make any sense because when you're in a debt-based economy, you have to have inflation. A debt-based economy means you're taking out loans, right? You're taking out future dollars today, and you want to pay them back then with future dollars, which need to be cheaper. Otherwise, what the hell are you doing?
Yeah.
So, again, the U.S. and Western countries, we're all in this debt-based economy. So you have to continue to increase. You have to keep the inflation going, which means you have to continue increasing the money supply. If you stop doing that, everything freezes up. The money, the liquidity is the oil in the machine. It's what makes things go. And if there's a stop up of it, if it just gets stopped, then the machine doesn't work anymore. And so, as you continue to increase more and more with your debt, as you increase, your currency more, you expand it, you have to continue to do that to keep the whole thing going, which is why it's something that likely doesn't last forever. It comes a tipping point where it's too much and you just can't sustain it anymore. But again, until that happens, same thing we're talking about the markets, until there's actually reversal, things can stay irrational longer than you can stay solvent, right? So, a lot of people out here talking about that we're going to have hyperinflation and whatnot, basically next year, tomorrow, whatever. It doesn't make a whole lot of sense. It doesn't happen overnight. And, any other previous times where they talk about it, you're talking about apples and oranges, right? The U.S. and the dollar are in a different position than Weimar Germany was in the 1920s, different than, everywhere else where they're having these things, right? With world reserve currency, the U.S. dollar is involved in something like 85% of worldwide commerce, right?
Yeah.
Over 55% of the world's debt is held in dollars. And if it's held in dollars, guess what, guys? It has to be paid back in dollars. So there's a demand for dollars to pay back the debt they have. So, it's an unwind that would take some time to happen. It's nothing that's happening tomorrow. It's nothing that's happening in 5 years. And sure, it'll probably happen at some point, but right now it's too integrated into the whole financial system to make a whole lot of sense that we get hyperinflation, anytime soon.
One more big picture question for you, and then I'll hone in on something smaller. From 08 till, we'll say 2020, when interest rates were low and we were pumping and printing money, inflation stayed low. And that was longer than a 4-year cycle, right? I mean, we're talking about a whole decade. What is your reasoning for that?
Well, we had pullbacks along the way, right? So it doesn't mean that it's because if you look at the global liquidity cycle, it moves in 4-year cycles. And if you look at the charts, you'll see, every 4 years or so over the last few decades, you'll see the rises and the pullbacks and the rises and the pullbacks along the way. So, basically the way we look at it is, the market has its correction when liquidity dries up a little bit, and it doesn't dry up completely. There's a slowdown in what's actually pumped out there, or there is a bit of a reclaim on it. For instance, here in the U.S., the Fed, when they're trying to increase liquidity, they buy MBSs, they buy mortgage-backed securities, they buy the treasuries, because they get to hold those and the cash they have goes out, right? And then when they're trying to bring in money, trying to soak up some of the money in the system, the easiest way they do it is by selling the MBSs and the treasuries back out there in the market, because the market participants want them, because we're talking about pristine level collateral. And so, those go back out and the Fed brings in those dollars. And when the Fed brings in the dollars, they don't get put back out of the system until the Fed sends them back out again, right? They're not sitting in, your corner bank waiting for you to take out a loan. So it's actually removing that liquidity from the system. So yeah, we've had that secular bull market up there from, 2008, 2009, but there have been pullbacks along the way. And we had some difficulty with inflation. 2015 or so, we had a very short deflationary period. And then again, I think we hit around 2018 or 19, pulled it back again as well. So the Fed really couldn't even keep inflation at 2% during that period. And then, of course, COVID came and all that happened. Everything shut down and printing presses turned on, and there it is. So
one of our comments is from Yowzer, and he says there are two types of liquidity. One is money that people have, and the other is the market cap of the item you want to buy. Does that make sense to you? Is that true?
Well, when we talk about
is that kind of comparing inflation? Like, is that another way of saying, like, the market cap of the item you want to buy? That's almost implying whatever the inflation rate is, correct? Or I guess the value.
Yeah, I like to keep it really kind of simple. And just, when I talk about liquidity, and when anybody talks about liquidity, what they should be referring to is the amount of credit and fiat currency, whatever, available out there. When you're looking at the market cap of an asset, right? You're looking, I guess maybe you're looking at potential liquidity, right? You're looking at, well, how much is there potentially in there? But not everybody's going to sell, and not everybody's going to sell at the same time. Not everybody's going to buy at the same time. So, again, when I talk about liquidity, I believe, people should be looking at just as the way of, okay, what kind of credit, what kind of fiat do we have out there available to actually put in it? Because you can go up there and go, okay, well, the market cap is whatever it is. Okay. And so that's great. And that's fine and whatever, but do people at the time have the ability to buy into it, or are they being forced to sell? Right. We always talk about there's two types of sellers. There's the willing seller and there's the forced seller, and if, global liquidity basically dries up and there's not all this ability to gain credit and to gain, cash to buy things and to do things, right? And you own an asset, right? You may be forced to sell part of that asset anyway, to get some cash in to pay your bills or to do whatever you're trying to do. So yeah, so when I look at that, that's what so when you talk about liquidity in markets, you're talking about the potential that's there versus, the potential is there based on what's already been purchased and where prices are at, versus does somebody actually have, or do people in general, does the market actually have the cash and credit to make those purchases, or are they, again, in tightening circumstances, are they going to be forced to sell?
Got it. No, that's very useful for me, kind of clicking a few Legos in my mind together. My micro question for you would be almost going back to our first, the first article that we wrote, more of a personal question. Should I sell my Bitcoin at any point in time? Because that article was making me think, like, one thing that I'm terrible at is, selling the high, buying the low. And so I'm just a holder, right? Because I know in general it'll go up. At least that's my belief. But I do know people who just wait until it goes up enough and then they sell, and then they wait until it goes down enough, right? And reading that article, his point was the goal is to make money. Right? The goal isn't to find the magic money. The goal is to make money. That's what you do with markets. So maybe I have the right mindset for the amount of experience that I have, but does that mean it's the most effective? I mean, obviously you're on the complete other end, right? You're trading every day. I'm not trading at all. But is that something, should I be looking and going, okay, Bitcoin gets to 100K. I think I'm going to sell because I know it'll drop down to, 70K in the future. And I'm talking like very long time horizon. Maybe I should say, oh, it'll get to 250 and drop down to 100 or something like that.
Yeah. So again, this is one of those things that I talk a lot about because I think this is, it's a great question. It's one of those really, really crucial areas that most retail traders and investors don't actually put any thought into. And what that means is they get caught up emotionally when the market does something quickly, like last Monday, right, or 2 Mondays ago. So basically, the way we look at this is we go, first of all, you've got to understand, who are you as a trader or an investor, okay? And so there's some questions that you need to be very honest with yourself. And this is the difficult part, because most people have trouble being honest with themselves, not just with trading, but just in life in general, right? We tend to think we're better than we are at things. And we tend to, the things that we screw up on, we tend to kind of shove, just kind of sweep it under the rug and say, it wasn't really all that bad. So when you do this, you go, okay, well, where am I at currently? What is my net worth? What is my income? Where do I sit currently? And then you have to say, okay, well, now I need to figure out what are my near, mid, and long-term goals, both with wealth and income. You've got to look at both, right? Because your income is what keeps you going, keeps your bills paid, and provides you capital to invest for wealth. So you want to figure out, how can I increase my income? What are my goals, short, mid, and long term? And because those are going to directly impact what your wealth goals are, short, mid, and long term. That's the easy part.
Yeah.
Then you get in there and you go, okay, so now we've got this. Now, what is my risk? How am I risk? Am I risk averse? Am I more risk tolerant? And again, you have to absolutely be comfortable. You have to be honest with yourself, because if you lie to yourself at this point, you're going to make very bad decisions. I know I'm much more risk adverse than risk tolerant. I was very risk tolerant in the beginning. I lost a crap ton of money. I chose not to be very risk tolerant after that. And so, being risk adverse, just getting into crypto is very is risky. Just crypto itself, because of the large swings. So you have to decide which one you are, and you have to absolutely be honest with yourself about it. Because if you say, listen, I'm risk tolerant, but you're really not, then the minute price starts moving a little bit, it's going to start making you uncomfortable, and then it's going to start making you sweat. And it's going to start making you very, very emotional, and you're going to start making decisions that don't align with your plan. And so then you have to figure, okay, now I've done all this. Now, whether I want to trade or invest, how much time do I actually have to do it? Let's be honest with it. If you've got an 8-to-5 job or a 9-to-5 job, wherever you got, you shouldn't be trading while you're working. You don't have the focus. You're going to make a lot of very bad decisions. Oh, no, I'll just set alerts and I'll just do whatever. No, you're going to make very bad emotional decisions, especially when something emotional happens at work. Work can be stressful often. Okay. And it's a very bad time to get into markets when you're stressed out. So you have to figure out, how many hours do you have to do it? What days do you have to do it? And then from that, you got to figure out, well, how many days and hours do I actually want to do it? If they're more than how many you have, well, that's too bad. You got to be, mechanical about the way you look at this. But if it's less than, let's say you have 4 hours a day, 6 days a week you could trade, but you only wanted to trade 2 hours a day, 4 days a week. You have to, again, it's all about understanding who you are and making a plan, having goals and making a plan to get there, which is what most people in markets don't do, which is why most of them end up becoming freaked out. They become emotional. They become scared when market does something. They jump in FOMO because the market's going the other way. And these are all very bad reasons to get into a trade or to get into an investment. So you have to go through all that to figure out where you are. And then you have to look at what you're actually investing in. Investing in Bitcoin is different than investing in IBM. It's different than investing in, whatever you're looking to invest in, Walmart or something, right? Because in Bitcoin is, first of all, very young. So it's going to make big moves over big periods of time, both up and down, as we've seen. but also it has the potential to change the way things are. And so if you're looking at that, well, now you have to give yourself, and you say, listen, I want to invest in it for the long term. I want to invest in it for ultimately my future, not to just make some money over the next few years, but I'm looking at this as a generational play, something that I can do now and I can, hold it for 20 years, because that becomes a different mentality when it hits 250. Because if you're looking at a 20-year time span, why are you even thinking of selling at 250, even if it did drop back to 100? It really just becomes a blip in the grand scheme of 20 or 30 years.
Yeah.
So again, it comes into understanding who you are at first, where you're going and how you're going to get there, and then understanding the asset that you're actually investing in. And again, this is a lot more work than most people actually put into it, which is why they get scared out, or they FOMO in when price moves dramatically one way or the other.
Got it. That makes sense to me. I want to get to one of the starred comments from Junie. Thanks, Junie, for the $2. I can't answer this question. I know, hopefully, Chris, you can. Why is BTC going up now?
You mean like today? Is that what we're asking, or do we mean like all last 2 Mondays ago?
That's all they asked. Why is BTC going up now? I assume, is it going up today?
Maybe locally here. It looks like if they're asking about here, as I pointed out, we had this range here. We had this candle. So if I do this off here, we have this large wick here with this large spike of volume, again showing us that we've got demand in this area here that's kicked it back up. We printed a wick below the previous swing low. That's called a bullish SFP, swing failure pattern, leads to this rally up. So, if we're wondering why we're doing that, it's quite possible that the range is complete. This is what we call a spring. And it was the last kind of shakeout, right? And we look at that because, again, in this range, volume dropped off and stayed low, and it only spiked on this day drop here, breakdown. And then so you get this huge bit of volume out of nowhere just on the breakdown, and then it leaves this large wick that closes back up below that swing low. So that generally suggests this is a shakeout. This range here, you can see the range continues to print these lower highs and lower lows. So when it's doing that, often what you'll get in range, as I draw this back on here, this range, right, is you'll have a big push to the low here, but it doesn't follow through. And so what it does is immediately all these breakdown traders here who went short on this breakdown, boom, right back that same day, they're underwater already because they were looking for the big breakdown that continues down further. But that first day, they're already back there underwater. The next day, they're definitely underwater because even the range here, they're back above that. And so, they're going to get out or they're going to get liquidated, and then they're going to go long. And that, keeps this whole thing moving forward. If you're asking about locally, let's kind of zoom in here a bit. Jeez, excuse me.
Bless you.
What's going on today?
The market got you sneezing.
Yeah, it did, right? So this morning we had PPI. If you need a narrative, I'm not big on narratives. If you ask me why this is around here, because it's 3 waves down, because it pulled back right here. It pulled back almost to the golden pocket, 61.8. So if you're asking me why is this going down, well, for me, it's technically here, which I want to show you something on the yen chart there, because I know you've asked about this a few times, Samuel. Yeah. But for me, technically, that was the reason to go long there, right? Now, this morning, PPI came out, Producers Price Index, and that came out much lower than expected. So the last reading, they were expecting 2.5. It surprised at 3%. So it was above. That wasn't good. It showed, higher cost, higher inflation, right? This time around, however, it was expected to be 2.7, and it actually came in at 2.4 core year over year. So that's excluding the volatile food and energy prices. It's everything else. So when you look at that, PPI is often used as a precursor to what CPI is going to be. CPI comes out tomorrow. So if you say, why is that going up today? You could argue that because PPI came in soft, inflation's coming down, the expectation is CPI tomorrow is going to come down. It's going to be soft as well. And so people, that's going to encourage potentially the Fed, encourage them even more to drop the rate in September. And so that's why people would be going long, right? Again, when you cut interest rates, that produces liquidity because it frees up the ability to gain credit, right? It frees up credit a bit more. So if you need a narrative, that's what I would say it probably is based off this morning. But again, for me, it's technical, right? It's where did it come out? Now, let me show you something here. So we've talked about this before, and you've always said, man, I don't know, man, wrapping my head around it, right?
Yeah.
So this is the US dollar against the Japanese yen. As you can see from back here in October of these are monthly candles, by the way. October of 2011, the US dollar has rallied against the yen, right? After dropping against the yen way back over here in 71, right? Okay. So that's what this is showing you. So off that low there, it's showing that the dollar is gaining in value against the yen. The yen is losing value against the dollar. Now, people are going to say, okay, carry trade, all this stuff, this is why it dropped. But technically, this is a target area you would look to get rejected at. It is, I can't zoom in a little bit here. What you're looking at is this previous swing high here, and then you had this move back up, which was rejected. So you're looking at basically that candle spread to that swing high there as a target area. And you basically hit the EQ of that. I'm real big about the way I draw my structures in which price often hits the EQ, the equilibrium, the midpoint of it. So people will say, okay, yeah, it's yen carry trade, that's what I did, and it's surprised and whatever, but it's not really surprising for me. In our academy, our trading academy, the USD yen is something that I update daily. And so we were already looking up in this area to start looking for a reversal, up here. Now, they might say, okay, but look, it bounced here because that was the day that the BOJ said, oh, wait a minute, you know what? We're going to hold back on doing the rate thing because all this crap happened on Monday, right? But if we look at that, let me kind of zoom in here. Oops, I need the weekly. There we go. This is an order block here. And again, right around the EQ of that is where we got it on that Monday. That was that Monday. And that was, they're like, oh man, wait, maybe we don't want to do this. But that's where it targeted. So, again, when I always talk about, what's going on with the charts, the stuff is there if you know what you're looking for and how to look at it. Now, that doesn't mean you're always going to get it right either, right? Nobody's perfect out there. The only guarantee in trading or investing, especially trading, is that you're going to lose money from time to time. And the newer you are, the more money you're going to lose and the more often you're going to lose it. Because nothing beats experience, right? Nothing beats being in the market, getting used to it, and getting out of all, there's a lot of free information out there. Most of the free information everybody's going to find when it comes to investing and trading, half-truths and outright lies. And they're going to lose you a lot of money. Think about it. If all this free stuff that y'all are finding online was really so great, why are so few people actually doing well as investors and traders? They're using that same information. And that's because, again, some of it's, just half-truths. The others are outright lies. And it's not because people are trying. I wouldn't say, generally speaking, that people are trying to dupe you. But it's this repetition of the same old thing over and over again that people have taken as truth. And once you figure out how things are really working, you can see why they did that, but it's not the full truth. It's not the full understanding that you read online. And so, again, when we talk about economic indicators, right, we talked about the Psalm rule recently and how that's supposed to indicate that a recession's in progress. And my rebuttal to that was, well, we're in a different employment market than we were prior to the pandemic. And the difference in that with the immigration, with the way in which the jobs are done and who's doing them and how they're doing them, suggests that, the underlying cause of what may trip the Psalm rule may not actually be that thing that it was prior to the pre-pandemic. And then, of course, we saw Claudia Psalm come out and say, yeah, listen, guys, I know my indicator said, yes, we're in recession. I don't believe we are for the reasons I just mentioned. And she said, we're uncomfortably close, but we're not there right now. And so, it's the same thing when you're looking at indicators and ways to look at charts. All the free stuff out there, there's some semblance to truth to most of it, but it's always without context. There's always something underlying that changes the way in which that outcome happens. Why is the outcome there? It's not just the outcome's there. Why is it there? And so that's why, what I do with our students and with people that I talk to is I always try to teach them to start looking beyond the initial reflex, the initial knee-jerk reaction, and understand what's making it happen. Because you'll see people talking about, for instance, death crosses and golden crosses all day long. A death cross is when you have, basically your one moving average move below your other. A golden cross is when it moves the other way. So death cross is bearish. Golden cross is bullish. But when it crosses depends on how long it's been going sideways. So often, a lot of times, people say, oh, look, there's a death cross, but price had been going sideways for months and it had already hit its low. So it's not going any lower. So there's always context that people are missing with most of the free information, most of the stuff that's just regurgitated by everybody out there. And that's why y'all have a lot of trouble being consistently profitable out there. It isn't fully your fault. I mean, there's emotions in there. That's yours. You have to accept that. But a lot of it as well is just not understanding the context with whatever it is that you learned for free or really cheap out there. That's just a regurgitation of things that people have said for decades and decades, but isn't exactly what you need to understand. So again, as I showed you on the chart there, we hit that thing up there. Okay, yen carry trade falls over, rolls over. We hit the bounce right at the order block. And everybody else that wants a narrative is just say, okay, it's because the Bank of Japan said, let's revisit this idea of raising interest rates.
Wow. No, and it's funny because I would have never even thought to go back to 1970, right, and look at some of the really long term, right? I was like, oh wow, when you put it that way, that is very fascinating. Well, we're at our over our 1 hour mark. Do you have any closing comments, Chris?
Listen, at the end of the day, I commend anybody that wants to get into the markets. Again, for me, anybody's heard my story. It took quite a while at first, right? It took multiple years of throwing money, just wasting money into the market before I sat down and said, stop being an idiot. You got to learn how to do this, right? But I know for a fact that once you figure it out, it can really kind of change your life. I'm living proof of that. I didn't have stuff at the beginning, right? Everything I've got is from what I've learned along the way. So if you're out there to do it, just understand that you can do it. You just have to, it's all about your mindset. If you're looking at doing everything for free, the odds of you being successful are going to dwindle quite a bit. That's just reality. I look at when I want to learn something, I put money into coaches and mentors and things like that, because I look at it as an investment to learn how to do it, right? So when it comes to things like business, for instance, with Gary, I mean, people are like, oh, I'd never work for free. Man, if you would say you'd never work for free, you haven't figured it out yet. Now, it doesn't mean maybe you can or can't work for free, but the fact that you automatically say, I would never work for free in a situation where you've got somebody who has been extremely successful doing their thing for a while, and you can pick up knowledge. You're not working for free. You're getting that knowledge and that experience, that hands-on. So, again, it's all about your attitude and how you look at it, but not just with trading, it's with life, right? Everything I teach, as far as trading goes, is applicable to life, because you can't be the same way. You can't be one way in some area of your life and be the opposite in another area of your life. Your brain doesn't work that way. Okay. So you're going to be the same way you are. So if you want to be successful in trading or investing, even, the first thing you got to figure out is, do I believe I'm a victim? And what does that mean? It means, do I believe that everything is always somebody else's fault? Do I ever take responsibility? And do I take responsibility consistently for whatever happens to me? Doesn't mean that somebody else involved doesn't have some portion of it's that their fault, right? If they're at play in there and they're duping you, well, I mean, that's on them. But the decisions you've made to get you to that point, where you're with them and allowing them to dupe you, that's yours. That's your responsibility. And it seems like such an easy thing, but it's hard for people to kind of accept that, because once you accept it, it means, well, now I'm not going to hold on to it. Now it's something that's happened and I took responsibility for my part in it. I can't do anything about their part at it. We all get hung up on the other person's responsibility, right? And we never move beyond. But once you take responsibility for what you did and you allow the other to just be, because you have no control over what they're doing or how they take it or anything else, that opens you up to be free to continue to do better. And so in order to trade or in order to invest, you have to believe that you can affect positive change in your life. And if you believe you're a victim, if you believe it's always somebody else's fault and you don't have any responsibility in whatever happened to you, then you don't believe that you believe you're at the behest of whatever forces are out there. And so how can you then enter the market with any conviction in a trade, right? You can't hold when it gets a little scary. You can't keep from FOMOing in when everybody else is FOMOing in. So, again, when it comes to trading, when it comes to investing, when it comes to life, you can't be a victim. You have to understand that you do have responsibility in getting to yourself the place that you're at. Doesn't mean that you have to take responsibility for what somebody did to you, but you did make choices and a series of choices over time that got you to that point. Accept that, forgive yourself, and look forward to doing more. And if you can do that, your trading, your investing life is going to be so much easier.
I think that's a great note to close on. Chris, I appreciate you being on here with me. Guys, as Gary always says, go do something nice for somebody. Don't tell anyone. Just do it because you should. I think that's a good general rule to live by. We'll be back tomorrow at noon. As always, I'm going live at noon every day this week. And Chris, I appreciate you coming on with us just about every Tuesday. And then our Twitter Spaces, Chris comes on Monday as well. So if you like this type of content, make sure you're following both Chris and Gary's YouTube accounts and Twitters. And we will see you guys tomorrow. Thank you again, Chris.
I appreciate it, buddy.